If you want to stop worrying about money and start living a rich life, this book will help you. It is not about cutting out coffee or feeling guilty about spending. Instead, it shows you how to grow your money, enjoy life, and build wealth without stress. Many people struggle with saving, investing, and managing money because no one taught them how. This book makes everything simple. It gives you a step by step plan to set up your finances so you can spend on what you love while still saving for the future. You will learn how to automate your money, invest wisely, and use credit cards the right way. You will also find ways to negotiate better deals, get rid of debt, and make sure your money works for you. If you want a life where you can travel, buy what you love, and feel secure about the future, this book will guide you. It is easy to follow, filled with real life examples, and will help anyone take control of their money and feel rich without being a financial expert. Chapter 1: Optimize Your Credit Cards. Credit cards can feel like a trap. We've all heard horror stories of people drowning in debt, paying sky high interest, and ruining their credit scores. But what if I told you credit cards aren't the enemy? In fact, when used the right way, they can actually make you money and boost your financial future. Most people don't realize how powerful credit cards can be. They're not just plastic for spending, they're tools that can help you build credit, earn rewards, and protect your purchases, but only if you play the game right. The problem: credit cards are misunderstood. Many people fear credit cards because they've seen others struggle with them. Maybe you've heard advice like, just cut up your credit cards and pay with cash. That sounds responsible, but it's actually bad advice. Credit cards themselves aren't the problem. It's how people use them. If you carry a balance and pay interest, you're losing money. If you only make minimum payments, you're stuck in a cycle of debt. But if you learn how to use credit cards properly, they can work for you, not against you. The fix: use credit cards the smart way. Here's how to make credit cards work for you. 1. Always pay your bill in full. Interest rates are ridiculously high. If you carry a balance, you're giving the bank free money. Pay your bill in full every month and you'll never owe a penny in interest. 2. Automate your payments. Late fees are a waste of money. Set up automatic payments so your bill is always paid on time. This also helps build a strong credit score. 3. Pick the best credit cards. Not all credit cards are the same. Some give you cash back while others offer travel rewards. Choose a card that matches your spending habits so you get free money on things you already buy. 4. Negotiate your fees. Most people don't know you can actually call your credit card company and ask them to waive fees, lower your interest rate, or increase your credit limit. Just ask. It's free money. 5. Check your credit score. Your credit score is like your financial report card. A high score means you get lower interest rates, better loans, and even cheaper car insurance. Keeping an eye on it can save you thousands over time. Using credit cards wisely isn't just about avoiding debt, it's about building wealth. A good credit score means you'll get approved for better loans, pay less interest, and even get better deals on things like apartments or insurance. Plus, if you're smart with rewards, your credit card can literally pay for vacations, gadgets, and even free flights. This isn't about being perfect, it's about being smart. Stop letting credit cards control you and start using them to your advantage. Once you do, you'll never look at them the same way again. Chapter 2: Beat the Banks. Let's be honest, banks are not your friend. They act helpful with their sleek apps, friendly customer service, and promises of rewarding savings accounts. But the truth? They're making money off you every single day, and you probably don't even realize how much. Think about it. You deposit your paycheck into your bank account, and what do? They take your money, lend it out, invest it, and make huge profits. And what do they give you in return? A pathetic 0.01% interest rate on your savings and a bunch of sneaky fees. It's not just unfair, it's ridiculous. The real cost of banking the wrong way. Banks love to nickel and dime people with fees. Ever been charged for using an ATM? How about a monthly maintenance fee just for keeping your money there? Or maybe you've been hit with an overdraft fee for spending a few dollars more than you had in your account. It's frustrating because it feels like no matter what you do, they always find a way to take a little extra. Now let's talk about savings. You've probably heard the advice: save money in a bank account and let it grow over time. Sounds smart, right? Except traditional banks barely give you any interest. Imagine having $10,000 in a savings account and earning just $1 in interest for the entire year. Meanwhile, The bank takes that same money and makes thousands off it. This isn't just about small fees and bad interest rates, it's about control. Banks set the rules, and if you don't pay attention, you'll keep losing money while they keep getting richer. Banks count on you not caring. Here's what's crazy: most people don't do anything about it. They accept whatever their bank gives them, assuming that's just how things work. And that's exactly what banks want. They know most people won't bother reading the fine print, won't question the fees, and won't switch to a better option because it feels like too much work. But once you start paying attention, you see the game for what it is. You realize you don't have to accept terrible savings rates. Don't have to let banks charge you just for keeping your own money. And you definitely don't have to play by their rules. The truth is, the system is designed to work against you, unless you learn how to beat it. And once you do, you'll never look at banks the same way again. Chapter 3: Get ready to invest. Investing can sound intimidating, like a game meant only for the rich or the experts. You hear the word and instantly think of Wall Street, stock tickers scrolling by, or high stakes gambling. But the truth is, investing is something anyone can do, and it's one of the best ways to build wealth over time. The real problem is that most people avoid investing because they're unsure where to start. They don't want to risk their hard earned money or make a mistake. But here's the thing: if you don't start, you're losing out on the chance to grow your money. And that's the biggest risk of all. Think about inflation for a second. Over time, the value of money decreases. A dollar today won't buy you the same things it could 10 years ago, and it won't buy you the same things 10 years from now either. If you keep your money in a savings account, it's just sitting there, losing value slowly. And investing is the key to fighting inflation. By putting your money in stocks, bonds, or other assets, you give it the chance to grow faster than inflation can eat away at it. This isn't about quick wins. It's about using time to your advantage and letting compound interest, your money earning money, work for you. The best time to start is now. The hardest part about investing is just getting started. It's easy to tell yourself you'll invest once you have more money or once you feel more ready. But here's the truth: if you wait for the perfect moment, you'll never invest. The earlier you start, the more time your money has to grow. That's the magic of compound interest. Let's say you start investing $100 a month at the age of 25. By the time you're 65, you'll have a nice nest egg. But if you wait until you're 35, it'll take a lot more money to reach the same goal. Time is your best ally, so don't waste it. Investing isn't about timing the market. A lot of people get caught up in trying to predict the next big stock, thinking they need to be perfect. But here's the secret: no one can consistently pick winners. Sure, some people might get lucky, but for most of us, investing is about consistency, not picking the perfect stock at the perfect time. The best way to invest is to focus on building a diversified portfolio. This means spreading your money across different types of investments: stocks, bonds, real estate, and more, to reduce risk. You don't need to be an expert to do this. With tools like low-cost index funds or exchange-traded funds, ETFs, you can invest in a wide range of assets with just a few clicks. How to get started? You don't need a lot of money to begin. In fact, you can start with as little as $50 or $100 a month. Set up automatic contributions so you're consistently putting money into your investments. You don't need to watch the market every day, stressing over the ups and downs. The goal is to stay consistent and let your investments grow over time. Once you've set up your accounts, you can choose low-cost index funds or ETFs. These funds allow you to invest in hundreds or even thousands of companies, all in one go. They're a great way to diversify without needing to pick individual stocks. Investing isn't just for the rich, it's for anyone who wants to build wealth and secure their future. The earlier you start, the more you'll benefit. You don't need a ton of knowledge or experience to begin, just the willingness to learn and start small. By investing wisely and staying consistent, you can create a solid financial future without worrying about inflation or missing out on opportunities. The time to start is now. Don't let fear or uncertainty hold you back. Your money won't grow on its own. You need to take action to make it happen. Chapter 4: Conscious Spending. We all spend money. Some of us do it mindlessly, without thinking twice about where our dollars are going. It's easy to get into a routine of swiping your card or clicking buy now on things you don't truly need. Over time, these small, unthoughtful purchases add up, and before you know it, you're wondering where all your money went, feeling like you're constantly running out. Conscious spending is about being aware of where your money is going, making sure each purchase aligns with what's important to you, and not just buying things because they're convenient, trendy, or seem like a good deal at the time. Falling into unnecessary habits. How many times have you bought something just because it was on sale, or grabbed an extra coffee because you felt like treating yourself? These purchases might seem small in the moment, but when you look back, they often add up to hundreds of dollars spent on things that don't really improve your life. We often fall into the trap of mindless spending because it feels easy. We don't think about the long term effects or whether we really need what we're buying. Maybe it's a subscription we forget to cancel, or new clothes we wear just once, or the extra gadgets we don't use. All of this adds up to money that could have been spent more meaningfully. Why conscious spending matters. When you spend consciously, you're being intentional with every dollar. Instead of buying things out of habit or boredom, you start thinking about whether each purchase brings you real joy or supports your long term goals. It's not about depriving yourself or cutting out everything fun. It's about focusing your spending on the things that truly matter to you. For example, if traveling is important to you, spending more on experiences that enrich your life and memories may be worth it. But at the same time, if you find that you're spending a lot on clothes you rarely wear or subscriptions you don't use, those are areas where you can redirect your money. Conscious spending doesn't mean being cheap. It means being smart and thoughtful with what you value most. Taking control of your spending helps you feel more in charge of your financial life. Rather than letting small impulse purchases slip by unnoticed, you can start redirecting your money toward what genuinely brings you happiness, supports your goals, or helps you grow. It's about making sure that each dollar spent is working for you. When you approach spending with intention, you start to feel like you're building the life you want rather than just getting through the motions of buying things. Conscious spending allows you to create a richer, more fulfilling life, not just in terms of your finances, but in terms of your happiness too. Every purchase is an opportunity to invest in what matters most. Chapter 5: Save while sleeping. Saving money doesn't have to feel like a constant struggle. In fact, the best way to save is to set things up so your money grows without you even having to think about it. Imagine waking up one morning and seeing your savings balance a little higher than the day before, all without lifting a finger. That's the power of automating your savings. The idea behind saving while sleeping is simple: make saving effortless. Instead of relying on willpower or remembering to transfer money each month, you set up systems that do the work for you. It's about making saving as automatic as paying your bills or getting paid. The problem: relying on yourself to save. The biggest obstacle to saving is forgetting or putting it off. Life gets busy, and it's easy to say, I'll save tomorrow. But tomorrow becomes next week, next month, and before you know it, the money never gets saved. Many people don't even realize how much they're missing out on by not saving consistently. Without a clear system, saving can feel like an afterthought rather than a priority. Another issue is trying to save whatever is left over at the end of the month. Most of the time, that's not much. You end up spending the money without thinking about it, and when it's time to save, you're left with little to put away. The fix: automate your saving. This is where automation comes in. The beauty of automation is that you set it up once and it works for you, quietly building your savings while you go about your day to day life. Here's how to make it work. 1. Set up automatic transfers. The easiest way to save consistently is to have money moved into your savings account automatically. You can set up a fixed amount to be transferred from your checking to your savings every time you get paid. When you pay yourself first before anything else, saving becomes part of the routine, not an afterthought. 2. Automate investments. Saving is important, but growing your money through investing is even better. By setting up automatic contributions to a retirement or brokerage account, you can take advantage of compound interest without having to think about it. Even a small monthly contribution can grow into a large sum over time. 3. Use apps to help you save. There are now apps that round up your purchases and save the change for you. For example, if you buy a coffee for $3.75, the app will round it up to $4 and save that extra 25 cents. Over time, these small amounts add up and you can watch your savings grow without any effort. 4. Make it effortless. The key to saving while sleeping is to make it as easy as possible. You want to set it up once and then forget about it. As your savings grow, you'll be amazed at how much you've built up over time, all without stressing about it. Why this matters. The real magic of saving while sleeping is that it works even when you're not paying attention. By automating your savings, You remove the temptation to spend and make saving a habit instead of something you have to think about. It's a way of building wealth quietly, day by day, without feeling deprived. The more automatic your saving and investing habits become, the less you'll have to rely on willpower or motivation to do it. You'll set it up, and over time, your wealth will grow without you having to constantly check in. This method isn't about taking giant steps. It's about consistent, small actions that build up over time. When you start saving without even thinking about it, you'll see your financial situation improve without all the stress. Saving while sleeping lets you focus on the things that matter most while knowing that your future is getting brighter with every automatic transfer. Chapter 6: The Myth of Financial Expertise. For years, many have been told that building wealth requires expert knowledge. The world of finance is often filled with complicated jargon and strategies, making it seem like you need to become a financial expert to manage your money successfully. But here's the truth: you don't need to be a financial guru to achieve financial success. Overthinking financial success. The pressure to understand every detail of personal finance can lead to paralysis by analysis. Many people hold off on saving or investing because they feel they don't know enough. They get caught up in complicated terms like capital gains, asset allocation, and dividends, thinking they need to master these concepts before they can take any steps. But this approach often results in doing nothing. Waiting for the perfect moment or waiting until you feel ready can keep you stuck in financial limbo. In reality, you don't need to be a financial expert to take control of your money. Overcomplicating things and focusing too much on becoming an expert can stop you from taking action. The simplest and most effective financial strategies are usually the ones that work best. A simpler approach. Financial success is not about knowing everything there is to know about money or becoming an expert. It's about focusing on a few core principles and applying them consistently. These basic principles will help anyone, no matter their background or knowledge of finance, build wealth over time. 1. Master the basics. At the core of financial success is this simple formula: spend less than you earn, save regularly, and invest wisely. These principles are straightforward and effective. By focusing on these basics, you'll establish a strong foundation for financial stability and growth. 2. Invest in what works. You don't need to try to pick individual stocks or chase complex investment strategies. Low-cost index funds are an easy and effective way to invest. They spread your money across a variety of companies, which reduces risk while allowing your money to grow over time. Investing in these funds helps you stay on track without needing to constantly monitor the market or become a stock-picking expert. 3. Automate your savings. One of the easiest ways to stay on top of your finances is to set up automatic transfers from your checking account to your savings or investment accounts. This simple step takes the decision-making out of the equation, ensuring that you save consistently and stay disciplined with your financial goals. 4. Think long-term. Building wealth is not about getting rich quickly. It's about consistency. The most successful investors are those who focus on long-term goals and let their money grow slowly and steadily over time. Stop worrying about short-term market fluctuations and stay committed to your plan. Compound interest will reward your patience. The bottom line: the myth that you need to be an expert to build wealth can hold you back. The reality is that you don't need to know everything about finance. By focusing on the basics, spending less than you earn, saving regularly, and investing in low-cost index funds, you'll be well on your way to achieving financial success. Rather than trying to become an expert, focus on taking simple actions and stay consistent with your plan. Start today, automate your savings, think long term, and let time and discipline work in your favor. You don't need to be a financial guru to build wealth. Just focus on the fundamentals and stick with them. Chapter 7: Invest for the long term. Investing can seem intimidating, especially with the constant flow of market updates, trends, and predictions. But the key to wealth building isn't about trying to time the market or making quick gains. It's about investing for the long haul. This chapter focuses on the importance of thinking long term when it comes to your investments and why sticking with your plan can bring the greatest rewards. Have the power of long term investing. When you invest for the long term, you allow your money to grow steadily over time, benefiting from the power of compound interest. Compound interest is like a snowball. It starts small, but as time goes on, it grows bigger and faster. The longer you invest, the more your money works for you. Small, consistent investments made early can grow into significant amounts over decades, even without dramatic returns each year. It's easy to get caught up in short term thinking, especially when the market dips or when a hot investment opportunity comes along. But the reality is, trying to time the market or chase the latest trend often leads to mistakes. In fact, studies have shown that long term investors consistently outperform those who try to buy and sell based on market timing. Why long term investing works. 1. Stock market growth over time. Historically, the stock market has shown steady growth over long periods, even though it can experience significant short term volatility. While there will always be ups and downs, staying invested over the long term allows you to weather the market's fluctuations and benefit from overall growth. 2. Compounding returns. The longer you keep your money invested, the more it compounds. Instead of cashing out during market dips, you can take advantage of the long term upward trend of the market, allowing your investments to grow exponentially over time. Even if you only start with small contributions, over years or decades, they can grow into substantial sums. 3. Avoiding emotional decisions. Short term market movements can lead to emotional reactions. Selling when the market is down or buying during a bull market out of fear of missing out. Long term investing helps you avoid these emotional decisions, keeping your focus on the bigger picture and the wealth you are building over time. How to invest for the long term. 1. Start early. The sooner you start investing, the more time you give your money to grow. Even small contributions made early on can lead to large returns over decades. Don't wait for the perfect time to start investing. The best time to invest is now. 2. Diversify your portfolio. Diversifying your investments means spreading them across different types of assets, such as stocks, bonds, and real estate. This reduces risk because if one investment performs poorly, others might perform well, helping to balance out any losses. Index funds and exchange traded funds, ETFs, are great ways to get diversified exposure to the market with minimal effort. 3. Stay consistent. One of the keys to long term investing is consistency. Set up automatic contributions to your investment accounts so you're regularly adding to your portfolio. By investing consistently, regardless of market conditions, you take advantage of dollar cost averaging, which means you buy more shares when prices are low and fewer shares when prices are high. 4. Be patient and stay the course. Long term investing requires patience. The market will fluctuate, and there will be times when it feels like things aren't going your way. However, staying invested and sticking with your long term strategy will allow your portfolio to grow through the market's ups and downs. Resist the urge to make hasty decisions based on short term movements. Investing for the long term is one of the most reliable ways to build wealth. By focusing on steady, consistent growth over time, you allow your investments to grow and benefit from compounding returns. Don't get distracted by short term fluctuations or try to time the market. Trust in the power of long term investing and let your money work for you. Start early, stay consistent, and be patient. The wealth you build over time will be a reflection of your discipline and commitment to long term investing. Chapter 8. How to maintain and grow your system. Building a solid financial system is just the beginning. To achieve lasting success, you need to keep it running smoothly and continue growing it as your life evolves. This chapter focuses on maintaining your system, making adjustments when needed, and ensuring that your wealth continues to grow over time. Track your progress. Once you have set up your financial system, it's essential to keep track of how things are going. Regularly reviewing your budget and tracking your net worth helps you stay on track and allows you to identify any areas that need attention. By checking your financial situation periodically, you can spot issues early and make necessary changes. Setting achievable milestones will also help you stay motivated and provide a sense of accomplishment as you move closer to your goals. Adjust as life changes. Your financial system isn't static. It should evolve with your life. As you experience new life events, such as changes in your income, career, or family situation, it's important to adjust your system to match your new circumstances. For example, when you get a raise or bonus, consider increasing your savings or investment contributions. Additionally, as you get closer to retirement, you may want to adjust your investment strategy to become more conservative. Staying flexible and adapting your system to fit your life will keep you moving toward your goals. Stay disciplined. The key to long term success is discipline. It's easy to get distracted by the temptation to spend more or chase after get rich quick opportunities, but staying disciplined with your system will pay off in the long run. Avoid lifestyle inflation. Just because you earn more doesn't mean you need to spend more. Stick to your plan, avoid impulsive decisions, and stay focused on your long term wealth building goals. Consistency is key, and staying disciplined ensures that your financial system continues to work for you. Keep learning. Personal finance is an ever evolving field, and it's important to stay informed. Continuing to educate yourself on financial matters, from investment strategies to tax laws, will allow you to make better decisions for your future. Knowledge is power, and keeping up with new trends and techniques will help you refine your system and grow your wealth. Whether it's reading books, attending seminars, or talking to experts, make learning a part of your financial routine. By maintaining focus on these key principles, tracking progress, adapting to life changes, staying disciplined, and continuing to learn, you can ensure that your financial system remains effective and continues to grow with you.